welcome you all for the very interesting program on important observations, qualifications, and disclaimers to be reported in a tax audit report. Hope all of you are busy in your tax audit, thinking that there is no extension. Even I am also strong view that there is no extension this time. We are also working hard for that. After finishing all audit, generally we'll be having a questions like, what disclaimer I need to give for this class? How to put that disclaimer, framing that disclaimer. So many we'll be discussing with our friends. When we discussed, even CA Deepak Chopra also is the right person. I thought he's the best person to give a guidance on these issues. When I requested, even in his busy schedule, he didn't say no. Whenever we ask from branch, no, he'll always extend his supporting hand to the branch. He said, okay, sir, we'll do it. I thank Deepak for guiding our members in this crucial time. It's a very interesting session for all of us. I welcome all of you once again for this program. I request our secretary Pramod to give a brief introduction of Deepak Chopra. Over to Pramod.
Thank you, Chairman. I take the privilege in introducing CA Deepak Chopra, who is a fellow member of the Institute of Chartered Accountants of India, who graduated in the Commerce from Bangalore University. He qualified as a Chartered Accountant in the year June 2011. He has a strong passion of direct taxes and has been regularly taking classes for the students of the Company Secretaries and Chartered Accountants course. He is a regular faculty member of the Bangalore branch of ICI for direct tax classes for students for CA Final. He has also been a resource person on direct tax matters at various forums, including Bangalore, Mangalore, Hubli, and other Karnataka and other districts. He has also been a resource person for a session hosted by Committee for Members in Practice. He has also been faculty for Officers of Income Tax Department at Direct Tax Regional Training Institute, Bangalore. He is also the chairman of Direct Tax Committee of KSAA, Karnataka State Chartered Accountants Association. He is currently partner in Deepak Neeraj and Associates, where he heads the Direct Tax Division. With this brief introduction, I welcome you once again, Mr. Deepak. And now I hereby present to you all Mr. Deepak. Over to you, Deepak.
Yes, sir. Allow me a minute to share my presentation. Do the necessary settings. Just give me 1 second, sir, while I set this up. Yes, thank you. My presentation is visible, sir?
Yes.
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 Yeah, thank you. Thank you. Namaste, and I wish one and all a very pleasant evening. We have assembled here on this online world for a discussion on important observations, qualifications, and disclaimers to be reported in a tax audit report. At the outset, I think we must all thank our branch chairman, Shri Srinivas sir, for having thought of such a unique topic. We've had several sessions in the past on clause by clause analysis of Form 3CD. We have had sessions on practical aspects of Form 3CD. We have had sessions on legal aspects, legal issues surrounding Form 3CD. But today's session, to my mind, is pretty unique in its content and its purpose. It's a common phenomenon in most CA firms, particularly in small and mid-sized CA firms, wherein although the audit is done effectively, the audit documentation and the audit communication is not effective. What is actually captured as part of our audit process is not pretty much well communicated in our audit, not captured in the audit documentation and not well communicated in our audit report as well. It is pertinent to note that if doing audit effectively is important, then communicating the same is even more important. Now, to address this issue of effective communication of an audit report is what this today's session is all about. Time is absolutely not a constraint in today's session. You can pause me, you can put in your queries in the chat box or in the Q&A box as and when they arise, and we'll try to address them as and when we are walking through a relevant slide. In addition, towards the end of today's session, probably say the ending 20-30 minutes will also be exclusively reserved for an open house discussion on various issues that possibly I have not covered, or if there is any addition that as members you want to make, you want to contribute to today's session. First things first, before we get into the clause Form 3CD, various clauses of Form 3CD, let's set right in our mind as to what audit report, what set of audit report has to be selected for the given SSC. As we are all aware, the law gives us two set of audit reports, tax audit reports, that is Form 3CA, 3CD, and then there is a Form 3CB, 3CD. So the most common notion or the most popular or layman's understanding of Form 3CA is that 3CA is meant for companies and 3CB is meant for non-corporates. Although this may be a statement true in 90-95% of the cases, this is not a universally true statement. Legally speaking, Form 3CA is applicable to all those SSCs whose accounts have been audited under some other law. So to say that Form 3CA is applicable only to companies and to non-companies Form 3CA would never be applicable would be an incorrect statement. I can give you an example. Take an example of an LLP. Now under LLP Act, there is a requirement to do a statutory audit under the LLP regulations if the turnover of the LLP crosses 40 lakh or if the capital of the LLP crosses 25 lakh. Now in such a case, a LLP whose capital has crossed 25 lakh or the turnover has exceeded 40 lakh, the LLP would be required to do its audit under LLP Act. And in case of such a tax SSC, the tax audit report would have to be uploaded in Form 3CA, 3CD and not Form 3CB, 3CD. The other statement that for companies, it is always Form 3CA, 3CD is also an incorrect statement. Again, it can be demonstrated with an example. Take the case of a company incorporated on 1st of Feb 2021. Now, in the case of such company, the first financial statement of the company would be drawn for the period 1st Feb 2021 to 31st March 2022. This is what would be presented before the shareholder. This is what would be audited by the statutory auditors of the company. Now, can this set of financial statement be considered for the purpose of tax audit? The answer is clearly no, because under income tax law, we follow the concept of previous year, and our previous year always commences on 1st of April and ends on 31st of March. So necessarily, in the case of such an entity, in the case of the company that we've considered for our example, a fresh set of financial statement beginning from the period 1st April 2021 to 31st March 2022 would have to be drawn. And this financial statement is not audited under the company law. This is not being subject to statutory auditors review and signature, and this is not what is being presented before the shareholders in the AGM. So in case of such company, the tax audit report would have to be uploaded not under Form 3CA 3CD, but under Form 3CB 3CD. As I said, at any point of time for every slide, I'll pause for a second or two to give you all participants time to type in your queries, or if there is any additional information that you want to add on to the discussion, to the conversation, please feel free to do it to the extent possible, because it very quickly flows through my screen. To the extent possible, I try to capture it and we'll try to address it then and there. So this is how a Form 3CA looks like. I'm sure we don't have to discuss on how to fill a Form 3CA or a Form 3CB. And this is our Form 3CB. The key difference to me in today's context between Form 3CA and Form 3CB is, now under Form 3CB, all disqualifications, observations, or disclaimers with regards to maintenance of books of accounts, you will disclose it in, you will put it in para 3 of Form 3CB. But when it comes to Form 3CA, if you have any disqualifications or observations with regards to maintenance of books of accounts, you will not put them in Form 3CA. You will put them in your main audit report. So if it's a company, you will put it in the statutory auditor's report, and that statutory auditor's report containing qualifications with regards to maintenance of books of accounts will be enclosed, will be attached along with the tax audit report, which is in Form 3CA 3CD. right? So qualifications pertaining to books of accounts, when it comes to Form 3CB, you will report it in para 3 of Form 3CB. When it comes to Form 3CA, you don't report it in Form 3CA, you would report it in your statutory audit report, and statutory audit report is to be annexed along with Form 3CA. Now, then there is also one provision to report your observations and qualifications pertaining to Form 3CD. So with regards to various clauses of Form 3CD, if you have any particular observations to make, any disclaimers, any qualifications to make, that you will make under para 5 of Form 3CB. And when it comes to Form 3CA, you will report it under para 3 of Form 3CA. So para 3 of Form 3CA and para 5 of Form 3CB is what is going to be our core subject matter of discussion for today. So here is where we'll pour in all our observations, all our disclaimers, all our qualifications with regards to the various clauses that we fill in our Form 3CD. As I said, the focus for today's session is going to be primarily on disqualification or on qualifications, observations with regards to various clauses in Form 3CD. Qualifications with regards to maintenance of books of accounts. For instance, inventory could not be properly ascertained, debtors reconciliation is pending, bank reconciliation is not happening. All of those are not going to be discussed today because that's something that we know very well and that's not something peculiar to a tax audit report. Our focus for today's session is going to be more on various qualifications and disclaimers that we have to give for our Form 3CD. Now, having said that, there is at least one observation with regards to maintenance of books of accounts, which I thought is a must-have discussion for today's session. Now, this is in the context of non-corporate entities, wherein financial statements are drawn purely from the aspect of computing taxable income and computing tax liability. If possibly Income Tax Act was not there, these individual sole proprietors, HUF entities or partnership firms would probably not even prepare the books of accounts. The only objective of preparing those books of accounts and getting them audited is to enable the assessee and the assessing officer to compute his taxable income and compute his tax liability. When a financial statement is prepared with this objective in mind, we often miss out on several other accounting aspects which are relevant for preparation of a true and fair financial statement. So this observation that's there before your screen seeks to address this issue in the most set of financial statements that we face. Let me read this out for you and then we'll have a more detailed discussion. So the observation that should, in my view, form part of the main audit report of your Form 3CB is that the books of accounts have been maintained by the SSC and financial statements have been prepared to primarily assist the computation of taxable income and ascertain the income tax liability. Strict adherence to all accounting standards has not been followed by the SEC. For example, accounting for fixed assets is not in accordance with AS10. So most individual HUF and partnership entities would compute depreciation on their fixed assets at the rates provided under the Income Tax Act. Now, those rates which have been provided in the Income Tax Act, depreciation rates, do not necessarily reflect the useful life of the fixed asset. Moreover, we don't do a proportionate depreciation depending on the number of days the asset was available to use. We do a 180-day criteria, full year's depreciation, half year's depreciation. Now, this in effect does not end up in reflecting your true statement of affairs and true picture with regards to your profitability, at least on the aspect of depreciation and your value of fixed assets. Accounting for retirement benefits is not in accordance with AS 15. I don't think any of the individual proprietary concerns or partnership firms make any provision for gratuity, because in any case, any provision that I would make in my books towards provision for gratuity would get disallowed under 40A7. Any provision that I would make for bonus payment would get disallowed under 43B. So nobody takes that effort of making that provision, making that computation, going to an actuary, getting a certification, getting a valuation done and incorporating that in the books of accounts. So all of these are not strictly adhered to. So what, maybe one question, end of the day, it is helping me compute my taxable income correctly. And if that, as long as that objective is achieved, why should I be bothering about this? Why should this observation get into my tax audit report? Because let us not forget, agreed, admittedly, that it is the tax assessing officer who is the primary user of a tax audit report. But then our tax audit reports are also relied upon by a host of other stakeholders. For instance, bankers look at our audited financial statements for sanctioning the borrowing limits. Partners use it for internal settlements. And there could be a host of other users. Vendors today ask for financial statements before onboarding or approving a particular vendor on their list. So there could be a host of other stakeholders. Keeping those in mind, we have to specifically highlight in our report that this set of financial statements is true and correct only for the purpose of preparing income computation statement and computing the tax liability of the SSC and nothing beyond. So the second paragraph, the purpose of audit under 44 AB as enunciated in Circular 636 dated 31st August 1992 is to ensure that true taxable income is reflected in the return of income. The deviation from accounting standards has no impact on the computation of total income under the Income Tax Act. The impact on the financials as a result of deviation from these accounting standards therefore has not been ascertained. This is something, in my view, which should very clearly be highlighted in all Form 3CBs, particularly in situations where accounting standards like AS 10, AS 15, AS, how many of us make deferred tax provision for proprietary concern? Right? We don't. But then it is impacting your financial statement. It is impacting your reporting of financial performance for the year. So this is something which is non-negotiable. This is a must-have in all Form 3CBs for all the tax audit reports that you sign off. So with this, we will now jump on to 3CD. Now, before 3CD, another non-negotiable component of your tax audit report, which has to be there in each and every tax audit report, this SA 700 statement. Now, this is again non-negotiable. This will have to form part of your 3CB as well as Form 3CA. The institute in the guidance note recommends that this should form part of the main audit report, and it should not come under the observations column, that is para 3 or para 5. But then in the utility provided to us, there's a technical constraint. I have a limit of 1000 characters, and this SA 700 statement, which is fixing up the liability of the assessee and the auditor with regards to preparation of financial statements and preparation of Form 3C, this is a pretty lengthy statement which does not fit in 1000 characters. So how do you incorporate this in the main audit report is a challenge which can be addressed in 3 possible ways. Option 1, use your WhatsApp and Twitter skills, shorten the language, balance sheet becomes BS, financial statement becomes FS, guidance note becomes GN. So compress it with your Twitter skills and ensure that it somehow fits in that 1000 character constraint. Or option 2, put it in the main body of the audit report that this is separately enclosed as an annexure. Print it, sign it, and attach it along with the financial statements that you're uploading at the time of filing the tax audit report, option 2. Or option 3, make a reference in the main audit report to the bottom qualifications that are present under para 3 or para 5 of the 3CB, 3CA and dump these over there. So regardless of where you put it, important point is it has to be part of your tax audit report somewhere. Attention to this has to be drawn, or this is something which institute takes it pretty seriously. As you would be aware, 2018 institute constituted a tax audit quality review board, which has become very active in the very recent past. And these instances of where the tax audit report did not incorporate this SA 700 statement was viewed pretty seriously by the tax audit quality review board, right? So with that in mind, I think nothing not too time consuming and or effort taking an exercise to incorporate it in your templates. Just ensure that it's there in every tax audit report, and all the tax audit reports sent out should capture this at some place, either in the main report or as part of an annexure, right? If you look at the utility given to us by the income tax department, there are a bunch of pre-filled observations which are available to us under the drop-down. To be precise, there are 16 observations provided by the income tax department, which they feel could be recurring and useful to the members, and which can be selected from the drop-down. Now, a look at this would show that these observations are indeed pretty heavy-duty observations, and one should be very careful while opting for this pre-filled observations. We'll read a couple of them and then see if at all they make any relevance or if they are going to be actually put to use in our tax audit reports. Observation number 1, proper books of accounts to enable reporting in Form 3CD have not been maintained by the SSC. If that is your case scenario, I would say you should not at all be issuing a Form 3CD. All the information and explanations which to the best of my or our knowledge and belief were necessary for the purpose of my or our audit has not been provided by the SEC. Then how on earth did you complete your audit, and why on earth are you issuing a tax audit report? So I think we can pretty safely conclude that the observations which are provided in a pre-filled format by the department are of not too much of use. I wouldn't be using them in my practice. I would straight away jump to the 17th item in the drop down, which is others. So the moment you select others, a remarks column gets activated, and you can pour in your emotions, you can pour in your disclaimers, qualifications in the way, in the manner you want it to be worded, and life is good over there. But then there again, we have technical constraints. I cannot be putting tables over there. There again, I have certain character constraints. So wherever I am limited in terms of not being able to fully express myself as part of other disclosures, there again, I will resort to annexure. So I would state with regards to clause 31, I have a disclosure to make, but because of character constraints, because of technical constraints, I'm not able to fill it in over here. And I have separately enclosed it as an annexure that may also kindly be referred to for the purpose of a tax audit report. And you can print, sign, scan, and upload it at the time of filing your tax audit report. Interestingly, wherever we are constrained in terms of disclosures or reporting in various clauses of Form 3CD, we take resort to this others column in Form 3CB or 3CA. And wherever we are constrained by technology in the others section, we'll have to resort to uploading it by way of a scan or an annexure. Okay, let's now begin with Form 3CD. We'll go clause by clause. I may not have covered all the clauses. I have tried to capture most commonly occurring disclosures or disclaimers which we might face in our daily practice. There could be some remote cases in your practice for which you might want additional disclosures or you might want additional discussion to happen. That is something that we will try to take it up towards the end of our session. So focus for now, for time being, is going to be daily use clauses which we use recurringly in most of our audits. We'll cover that up first, and then time permitting, which of course is not going to be an issue today, towards the end of the session, we'll take up individual queries with regards to clauses which are not covered in my slide today. Okay. So part A is pretty simple, easygoing. I don't think there should be any difficulty with regards to filling up clause 1 to 8 of Form 3C. But then I had a bunch of queries in my mind, which I thought, it's a bunch of thoughts in my mind, which I thought I should be sharing with all of you over here. First, foremost, clause 1, name of the SEC. Now, what is it that we normally fill in over here? What is expected out of us to be reporting under clause 1? I would request the participants to be a little more interactive, and they can put in their response in the chat box. You know, in the online world, this is the maximum interaction that we can have. Otherwise, it's going to be a one-way lullaby, and after half an hour, 40 minutes, this being a slightly dry topic, I'm sure a lot of you would be logging off or dropping off. So I would request participants to put in their answers on the chat box. Okay. Okay, so normal expectation, as is being rightly stated, is that the name as per PAN records is what is expected to be filled under clause 1. Now, when it comes to a proprietary concern, so let's take X, Mr. X, proprietor of X and company. Now, what should be filled in over here? Should I be writing Mr. X or should I be writing Mr. X proprietor, or should I be writing the name of the trade name of the business entity? Name as per PAN record is one answer that I've got. Yes, sir. That's the common understanding. You're right, madam. But with regards to a sole proprietor, I am of the view that please don't stop with just the name, the legal name of the proprietor, that is Mr. X. Please go on to also add to say Mr. X, proprietor X and company. Now, this is with an intent to give clarity to the reader of our tax audit report, which predominantly is the assessing officer, that boss, look, I have done audit of X and company. I am not auditing Mr. X. My scope of audit is limited to the transactions that are accounted in the books of accounts of Mr. X. So X and company is my scope. What Mr. X does outside the books, what Mr. X does in his personal books is something which is not within the purview of my audit. So it's a healthy exercise to not just stop with Mr. X, but go on to add and say Mr. X, proprietor, X and company. Right. Next common disclaimer that we give on is with regards to clause 4. So clause 4, the requirement is to report various registrations under the indirect tax regime which the SSC has undertaken. Now, this could at times get pretty complicated, especially with large entities, with businesses across the country. They'll have a Bombay registration, they'll have a Bangalore registration, and they might have something called as casual registration. So indirect taxes are something which I personally don't very clearly understand. So I always make it a habit to take a representation from the management that these are the laws under which they are required to get themselves registered, and these are the registration numbers. And I also go ahead and give this as a disclaimer in my tax audit report to say the information furnished under this clause is based on information provided by the SSC. Because beyond this, there could be some other law applicable to the SSC which I am not even aware of, and under which he is not taken a registration. To just cover that portion of my audit risk, this small disclosure, this small disclaimer in your para 5 of Form 3CB should be helpful. Clause 9 has reporting requirements in case of a partnership firm or an LLP. Subclause A requires you to indicate the names of the partners or the members and their profit sharing ratio. Now here I have two set of queries. Query number 1. Now if a partner is represented by another individual, let's take an example of HUF. HUF being a partner in a partnership firm is represented by its Karta. X-HUF is represented by Karta X. Now, what is it that you will disclose under clause A? What is it that you will report under clause 9 subclause A? Should I be reporting the name of the beneficiary, that is X-HUF, or should I be reporting the name of the representative, that is the Karta X? I'll pause for you to put your answers on the chat box. I'll repeat this question. So X-HUF is a partner in a partnership firm. Clause 9 subclause A, what should be reported? Should it be X-HUF or should it be Mr. X? As rightly pointed out, the institute's guidance note tells us that it is the name of the beneficiary and not the name of the representative that will be reported under subclause A of clause 9. But then again, I would deem it to be a healthy practice to also put it in my observations to say X-HUF is represented by Mr. X. We may have instances of a company being a partner represented by its director. So I'll add additional information in my Form 3CB to say X Limited, a partner in this partnership firm, is represented by its director, Mr. Y. Right? It's always good and nice to come clean with possible additional information, additional disclosures in our Form 3CB. So the next issue that I have with regards to, again, subclause A is in partnership deeds wherein the profit sharing ratio is of not fixed nature, but something of this kind. You will see this quite a lot in case of professional firms where lawyers, company secretaries, or chartered accountants come together to form a partnership. You will find that the profit sharing ratio is something like this. First 5 lakhs of the profit is equally shared between 3 partners A, B, C, 1:1:1. Next 5 lakhs is shared in the ratio 1:1:2. And any profit in excess of 10 lakh is shared in the ratio 1:2:2. Now, when this is mathematically applied, the effective profit sharing ratio for year 1 works out to 15:17:21. This is just a hypothetical number. And for year 2, the profit distribution ratio works out to 15:15:17. Now, the query here is, what should I be stating under subclause B? Should I say that there is a change in the profit sharing ratio, or should I maintain a statement that there is no change in the profit sharing ratio and report a no in subclause B? In my view, in subclause B, you should be reporting that there is no change in the profit sharing ratio, because in fact, there is no change in the profit sharing ratio. It is just that the profits are distributed in a different ratio, which is in accordance with a consistent profit sharing ratio. So in my view, you should be reporting a no under subclause B, but that no should come along with certain additional disclosures in the Form 3CB and the suggested disclosures over here. So a suggested disclosure, you could of course change the language to suit your requirements. There is no change in the agreed profit sharing ratio among the partners. The agreed profit sharing ratio among the partners continues to be as was in the previous year. That is equal profits for first 5 lakhs, 1:1:2 for next 5 lakhs, and 1:2:2 for balance profit. However, the effective profit distribution ratio works out to 15:15:17 in the current year, as against 15:17:21 in the previous year. Right. Clause 10 requires you to report nature of business of the SSE. Again, the institute in the guidance note tells us you will not report every business activity carried out by the SSE. Only the principal line of business of the SSE is what you will report. Subclause B requires us to report any change in the nature of business or profession of the SSE and the particulars of such change. Now, a common query that comes to our mind here is again, what if there is a temporary change? Now, take an example of an SSE who during COVID switched from manufacturing operations to trading operations. So I'm a manufacturer of, let's say, garments, but because of repeated lockdowns and shortage of labor, for 2-3 months in that COVID year, I resorted to trading operations. But this, in my mind, was a temporary operation, and moment everything came back to normalcy, I have resumed my manufacturing operations. So should this be reported as a change in the nature of business of the SSE, or should I be reporting that there is no change in the nature of business of the SSE? Is again a question which could be debatable. Different experts may have different views. My mid view is whatever decision, whatever judgment that you arrived, whatever conclusion that you arrive at based on your judgmental call, please report it additionally as part of additional disclosures in para 5 of Form 3CB. Again, I have a suggested reporting over here. So the SSE is a manufacturer of garments. However, there was a labor strike for 2 months during which the SSE carried out trading operations. Post strike, the SSE has resumed manufacturing operations. This temporary change, there's a change. I'm admitting there's a change, but this change is a temporary change. So this temporary change, in our view, does not constitute a change in nature of business of the SSE, and therefore has not been reported as a change under clause 10B of Form 3C. Right? This view, in fact, also syncs with the view of the ICI in the latest guidance note. Clause 11 with regards to has reporting requirements with regards to maintenance of books of accounts, the location addresses where it has been kept, and the list of books of accounts and documents which have been examined. Now, it is quite often seen, particularly in mofussil areas and with regards to small traders, small business entities, they don't maintain any regular day-to-day books of accounts. End of the year, the documents are dumped in a box. They're all collated, sales invoices, expense vouchers, purchase invoices, all of those are collated and dumped in the CA office. He'll do the accounting, he'll do the audit, he'll upload the return. So there's a definite issue with regards to independence and ICA regulations. I'm not on that for now. The query here is where in fact the books of accounts are lying at the time of signing of the audit report in the premises of the chartered accountant. What should I be quoting as address where the books of accounts are kept? For heaven's sake, don't quote the address of the chartered accountant office. Don't quote your office address, because whatever address you report over here under clause 11 subclause B will be the first premise that the department would visit in case they intend to take up a survey or search action in the case of an SSE. Right? So at no case, at no point of under no situation or no circumstance should the office address of the CA be reported under clause 11 subclause B. On a more serious note, we've often seen, it's of late become pretty common, that books of accounts are maintained in cloud. We have a lot of online accounting softwares, Zoho, QuickBooks, a lot of them. In such a scenario, what should I be reporting as the address where the books of accounts are kept? The institute in our guidance note tells us that you will report the address of the server where the data is saved. Now, that may be a bit of a challenge. I don't think that is something which is practically possible. With that in mind, there's a suggested note that should get into our observations, which reads something like this. So the core books of the SSE are maintained in cloud servers. As the server locations are dynamic and not identifiable, you ask Zoho guys, you ask QuickBook guys, which server is my data actually sitting on? Even they will not be in a position to answer it, because sometimes it is in Singapore server, sometimes it is in California server. It's a very dynamic exercise. That's something even they will not be in a position to answer you. So as the server locations are dynamic and not identifiable, we are unable to report the physical location of the servers where the books are maintained. However, the servers are hosted by XYZ Limited, which is the service provider whose registered office is so and so. So in case department wants to access those books of accounts, they can always approach these guys, and through these service providers, they can certainly access the books of accounts of the SSC. The other books of accounts of the SSC, including payroll registers, stock movement registers, etc., are maintained by the SSC at its registered office, which is at so and so location. So we have an additional input from Shrikar S. Now it is mandatory to maintain server in India as per MCA regulations. Yes, thank you, sir. Thank you for the input. So for a company, MCA regulations mandates that the server should be located in India, but there again, it's still going to be dynamic. Sometimes it is in Hyderabad server, sometimes it is data is moving to Chennai server, sometimes it is Mumbai server. I'm sure even in spite of the servers residing in India, we will not be in a position to give a precise address of where exactly is my data residing. Right? And of course, this restriction does not apply to non-corporates. There is a data law which is coming up where again there will be a mandate to maintain data within the territorial boundaries of India. But still, even in that scenario, I think this disclosure would be relevant for all our tax professionals. Clause 12, whether profit and loss account includes profits and gains from any presumptive tax provisions. This is again one standard disclaimer that we give in our tax audit reports. According to the information given to us, profit and loss account does not include any profit and gain accessible on a presumptive basis. You may or may not decide to retain this in your tax audit reports. Clause 13, we have requirements with regards to maintenance of books of accounts, the method of accounting, change in the method of accounting, that is clause 13A, B, C, and clause 13D, E, and F have reporting requirements connected to ICDS. So if the application of ICDS has any monetary impact on your income computation, you will report a yes in clause 13 subclause D. You will quantify that monetary impact in clause 13 subclause E. And finally, in clause 13 subclause F, you will report various disclosure requirements in accordance with various ICDS applicable to the SSC. So in all, as we are all aware, we have 10 income computation disclosure standards, which are pretty much similar to the accounting standards that we have under the company law or the standards issued by ICI for non-corporates. Now, out of these 10 standards, 8 standards have disclosure requirements, which is again very similar to what we have under our existing accounting standards. So out of the 10 standards, ICDS on securities, ICDS 8, and ICDS on Forex, that is ICDS 6, does not have any disclosure requirement. 8 of the balance income computation disclosure standard, each of them require us to report the various or meet the various disclosure requirements of ICDs. Now, a query here is that if a certain ICDS is not applicable to an SSC, can I altogether skip that line item and jump over to the next ICDS? For instance, let's say ICDS 3, construction contracts, is not applicable to my SSC user trader. So can I altogether ignore it? Can I altogether omit it from the list of drop-down that I have for clause 13F? Or do I have to still report that this is not applicable? Now, Institute is of the view that even if a particular ICDS is not applicable, you will have to select it in the drop-down and say it is not applicable. So, for example, in our case, construction contract, a trader has nothing to disclose under ICDS 3. You will not omit ICDS 3 from the line item. You will select it from the drop-down, and in the remarks column, you will state that the SSC has not undertaken any construction contracts during the previous year. Therefore, the requirements of disclosure requirements of this ICDS 3 is not applicable to this. This is a statement Institute expects you to report for each and every standard, even if that particular ICDS is not applicable to the SSC. With this, I thought it would be relevant to walk through a bunch of sample disclosures that one should be making under ICDS as well, starting with ICDS 1. ICDS 1 deals with accounting policy, very similar to the AS1 that we have in our Institute set of accounting standards. So a sample disclosure could read something like this. So we are required to disclose the basis for preparation of financial statements. So the financial statements are prepared under historical cost convention in accordance with the generally accepted accounting principles as adopted consistently. Expenses and incomes are accounted on accrual basis. Now there are certain additional disclosure requirements under ICDS 1. If there is a change in the accounting policy, let's say you've changed your depreciation policy from WDV to SLM, right? So that would have to be reported here. A brief description of the change, monetary impact of the change. So had I continued with SLM and not opted over to WDV, my depreciation for the year would have been X. So because I have now changed my depreciation policy, my depreciation for the year is now Y. So X minus Y is the monetary impact of the change, is something that you have to report. If it is not quantifiable for some reason, then the fact that it is not quantifiable will have to be reported over here. If change has an impact in subsequent financial years, that should also be quantified and reported over here. And then lastly, we have a set of specific disclosures. If a fundamental accounting policy is not followed, example, the assessee has incurred huge losses and the net worth of the assessee has been completely eroded. The going concern presumption in the case of the assessee does not hold good any longer. Therefore, the accounts have been prepared on liquidation basis. Right? This is a rare scenario which I'm sure we will not encounter in our daily practice. ICDS 2 has disclosure requirements with regards to inventory, pretty similar to AS2. So the inventories are valued at lower of cost or market value. This is a standard statement that you will give for all SSCs where there is inventory. If there's no inventory in the books, let's say it's a service provider and he holds no inventory, he will make a statement that he holds no inventory and therefore disclosure requirements under ICDS 2 are not applicable to the SSC. B, cost of inventories is ascertained on weighted average basis, or it could be FIFO, or it could be specific identification of inventory, or it could be standard costing. So these are the only 4 permitted methods, both under AS2 as well as under ICDS2. You cannot have FIFO or simple average or any other method of cost ascertainment of your inventory. It has to necessarily be either FIFO, weighted average, specific identification method, or standard costing is also now permitted under ICDS 2. Now, ICDS 2 requires us to follow ICDS 2 read with 145A requires us to follow inclusive system of accounting. Now, what is inclusive system of accounting? It is pretty different from the exclusive system of accounting that we normally follow. Now, under exclusive system of accounting that we follow in our daily accounting, all those taxes which are subsequently recoverable or refundable from the government do not form part of cost of inventory. To give an example, let's say I have bought this pen at 100 and I paid a GST of 10. Under exclusive system of accounting, the cost of this inventory, so the purchases that I will debit to my P&L account would be 100, whereas under inclusive system of accounting, I will debit my trading account, purchases account with 110. Now this is the same rule which will apply to all components of my trading account. Opening stock, closing stock, sales, purchases, all of it will be inclusive of taxes under inclusive system. Under exclusive system, all of it will be excluding taxes. So how does it impact? The net impact on your gross profit or your net profit is going to be 0, because under inclusive system, all the taxes which you ultimately pay or are liable to pay will again be debited to your trading account. It will be debited to your P&L account. Under exclusive system, we route taxes collected and paid through our balance sheet. So it's all in all only going to result in a presentation difference. Otherwise, it is going to have no impact on your income computation or computation of the tax liability of the SSC. Therefore, it is not necessary for us to redraw our trading account or P&L account under inclusive system of accounting. But because there is a violation, because there is a deviation from what is prescribed under 145A or what is prescribed under ICDS 2, this important observation should form part of your disclosure requirements, which is exclusive method of stock valuation is followed. It has been held in following cases that exclusive method of stock valuation is revenue neutral. Even Supreme Court in the case of Berger Paints, Indo-Nippon Chemicals, Gujarat High Court in the case of Lakhan National Limited has acknowledged that inclusive or exclusive is only a matter of presentation. It does not have any income bearing. It is a revenue neutral exercise. So as well, the SSC may not do it. But then this disclosure should certainly be there as part of your tax audit report. So we have a query from Mr. Amresh K. Do we need to report under observation that SSC has followed exclusive method? Yes, sir. We will have to report. So we will report this at 2 places. We will report this one under ICDS 2 disclosure. And there is one more place under 145A reporting requirement, which will come in a short moment in our subsequent slides. We will be reporting the same reporting requirement over there as well. Lastly, for ICDS 2, you will also report the total carrying amount of inventories, inventories held for sale in ordinary course of business, which is your finished goods, inventories in the process of production for such sale, work in progress, inventories in the form of materials or supplies to be consumed in the production, which is your raw material. This breakdown is expected and mandatory under ICDS 2. Next, ICDS 4, revenue recognition. Sample disclosures. Revenue is accounted as and when it is accrued. Income from service contracts is determined under percentage completion method. Please bear in mind, project completion method is not an option available to you under ICDS 4. AS9 permits you to account for revenue either under percentage completion or project completion. ICDS 4 prohibits project completion method. It mandates you to recognize under percentage completion method. The only exception being in a case where your period of service contract does not exceed 90 days. If the period of service contract does not exceed 90 days, then you have an option to follow project completion method. For all other revenue contracts, you necessarily have to account for revenue under percentage completion method only. Third item of disclosure, the amount of revenue from service transactions recognized as revenue during the previous year. So you have to quantify revenue from services and separately disclose it under ICDS 4. Revenue not recognized due to lack of reasonable certainty in collection. So if there is any service that you have rendered to Vijay Mallya and you are expecting an audit fee, you build in, you would certainly not recognize in your trading account because there is no reasonable certainty of ultimate collection of that revenue. You will not record it, and in such scenarios, you will have to report it here under ICDS 4 disclosure. For service transactions in progress, you will have to report cost incurred, revenue recognized, amount of advances received, and amount of retentions that you have received. I think I jumped 2 slides. We missed ICDS 3. Yeah. So ICDS 3 has two set of bunch of reporting requirements, one under para 23 and one under para 24. Under para 23, you're required to disclose the amount of contract revenue recognized as revenue in the period. Again, this will have to be done under percentage completion method. Project completion method is totally prohibited under ICDS 3. The methods used to determine the stage of completion of contract. So stage of completion of contract is usually determined in accordance in proportion to the expenses incurred vis-a-vis total estimated expenditure. So for this construction project, I estimate a total construction cost of 10 crores. I have incurred till now 5 crores, so 50% of my project is ready. This is the most common way of ascertaining the stage of completion of the contract. Some cases we've seen that it is also done on the basis of architect's report. So architect physically evaluates, physically visits and identifies, okay, foundation, first slab, second slab laid, 30% of work is completed. Based on architect certificate also, stage of completion of contract can be identified. Under para 24, you are required to disclose the amount of cost incurred, profit recognized, losses recognized, amount of advances received, and amount of retentions. Pretty similar to what we saw in ICDS 4 with regards to service contracts. ICDS 5, tangible fixed assets. So this is a sample, again, sample disclosure. Fixed assets are stated at WDV plus additions, less deletions, and less depreciation charge for the year. Depreciation of fixed assets is provided according to the methods and rates prescribed in income tax rules. For written down value of assets and depreciation claimed under and other disclosures under para 19 of ICDS 5, please refer to clause 18 of Form 3CD. So para 19 of ICDS 5 has a bunch of reporting requirements, all of which is very well captured in our reporting in clause 18. So in my view, it's not necessary to re-report what is already there under clause 18. It's fair to say that please refer clause 18. It's a fair practice to draw reference to the disclosures which are already made in clause 18 of Form 3CD. I guess I jumped. Yeah, so ICDS 5, ICDS 6, which deals with Forex, has no disclosure requirement. Thankfully, there's nothing that we have to disclose over there. ICDS 7, dealing with government contracts, something that we don't see very often. I just quickly rush through this. Nature and extent of government grants recognized by way of deduction from the actual cost or WDV of the fixed assets. That's point A. Nature and extent of government grants recognized as income. Point B. Nature and grants not recognized by way of deduction from actual cost or WDV of the asset for various reasons. Reason could be I'm not fulfilled the grant conditions. There is no reasonable certainty of actually receiving the grant for varied reasons. If there is any government grant which is not recognized, you will quantify it and you will also give the reasons for not recognizing it. And lastly, nature and extent of government grants not recognized as income and reasons thereof. Para 13, ICDS 9, borrowing cost, again a sample disclosure. Borrowing costs that are attributable to the acquisitions, construction, or production of qualifying assets are capitalized as part of such assets, which is the requirement both under AS 16 as well as ICDS 9. A qualifying asset is an asset that necessarily requires a substantial period of time to get ready for its intended use or sale. All of the borrowing costs are recognized as an expense in the period in which they are incurred. Details of borrowing costs capitalized during the year is so and so. This is something that you have to quantify and disclose over here. That's ICDS 9. ICDS 8 deals with securities. Again, there's no disclosure requirement over there. Lastly, ICDS 10 deals with provisions, contingent liabilities, and contingent assets. Although the ICDS deals with three components, provisions, contingent liabilities, and contingent assets, the disclosure requirements are only with regards to provisions and contingent assets. With regards to contingent liabilities, there's nothing that we have to disclose under ICDS 9. So for provision, you'll have to disclose a brief nature or a description of the provision. Let's say provision for gratuity. Opening balance, provisions made during the year, amount incurred against the provision, unused provision, amount of any expected reimbursement. This is what the standard required. In our office, we also want to add a point G to say closing balance of the provision. So this captures in all my complete movement of provisions, which will also assist me in my income computation and which will also assist me in answering the assessing officer at the time of scrutiny. For contingent asset, the disclosure requirement is give a brief description of nature of asset, the carrying amount at the beginning of the year, additional amount of asset and related income recognized. If the asset and income is recognized, it is no longer a contingent asset, it is an actual asset. But that is how the standard reads. That's the disclosure requirement of the standard. Amount of asset and related income reversed. Right, I'm sure we'll not have too many scenarios, real life scenarios, where we'll be reporting something under this head. Okay, so we are done with our 10 income computation and disclosure standards. Let's now come back to our various clauses of Form CCD, starting with clause 14. Now, clause 14 again speaks of method of valuation of closing stock and whether there's a deviation from 145A. So, Amresh ji, I think this slide answers your question. So we have already, as part of ICDS 2, disclosed that we have deviated from ICDS 2 by adopting exclusive method of accounting, but that disclosure will have to be made once again with regards to clause 14, and this is one sample disclosure that possibly you can make use of. So the SSC has followed exclusive method for stock valuation. It has been held in following cases that exclusive method of stock valuation is revenue neutral. In view of the above, non-following of inclusive method of stock valuation has no impact on the total income for the year. So this is again a non-negotiable disclosure. This has to be there for all trading and manufacturing entities. For entities where you don't have closing stock, probably you could do away with. No, even there, in fact, sorry, ICDS 2 disclosure can be optional for a ICDS 2 disclosure could be optional for a service industry, but then 145A is applicable to a service industry as well. Our Pramod sir has put in a point. Yeah, yes, sir. The guidance note, unfortunately, the 2022 guidance note has omitted this, sir. If you look at 2014 guidance note, the institute has spent close to 14 to 15 pages with various illustrations, various examples, various scenarios demonstrating that inclusive system or exclusive system, the result of net profit is always going to be the same. They've spent about 14-15 pages in the 2014 guidance note. But then since then, the law is pretty settled, with Supreme Court also acknowledging in the case of Berger Paints and Indo-Nippon Chemicals. In the 2022 version of the Institute's tax audit guidance note, you will see that those 14 pages have been scissored. So you will not find those illustrations in the 22 guidance note. If at all you want to look at practical illustrations on how inclusive versus exclusive system works, you will have to go back to 2014 guidance note. Right? Okay. Having said this, having spoken of Supreme Court, having spoken of Institute's guidance note, is this a universally true statement to say profits under inclusive and exclusive system are always going to be equal? Can there be any extreme or rare scenario wherein the profits as per inclusive system is going to be different from profits as per exclusive system? But this is an open question that I'm throwing to all the participants. I would wish to see a couple of attempts in the chat box. Give me at least one instance where profit under inclusive system is going to be different from profit under exclusive system. I'll pause for a minute to for the participants to apply their mind and come up with some possible examples. Under cash system of accounting, if your SSC is, let's say, registered under GST and he is following cash system of accounting, then the P&L drawn under inclusive system versus exclusive system will give you different profit figures. If the GST for the month of March is not paid before 31st March, the earlier in the service tax era, service tax liability for the month of March would also be discharged before 31st of March. So therefore, this issue of inclusive versus exclusive would not arise then. But now under the GST era, GST for the month of March is not discharged by 31st of March. We have time till 20th of April. So all SSCs following cash system of accounting enrolled under GST would have a GST liability outstanding as of 31st of March. To that extent, your profits under inclusive system versus exclusive system is going to differ. So if you have an SSC following cash system, registered under following cash system means necessarily has to be a service entity. Traders and manufacturers following cash system will make no sense. You will have a totally distorted P&L account. That is absolutely not possible, practically not feasible. So if your SSC is a service SSC, professional like us, chartered accountants, lawyers, following cash system, registered under GST, have a unpaid GST liability as on 31st of March, you will have to redraw the profit and loss account under inclusive system, and you will have a difference in profit versus inclusive versus exclusive to the extent of GST unpaid, to the extent of GST unpaid as on 31st of March. So there you'll have to be a little cautious, and you'll have to ensure. So there you cannot be relying on this observation, this disclosure. You will have to do the math once again. Clause 15. So here the reporting requirement is give the details of capital asset converted into stock in trade. Now there's a audit challenge over here. Okay, before coming to the audit challenge, what are we actually referring to under clause 15? So clause 15 is referring to a scenario of 45(2)(a), right? So there's a capital asset which is now converted into stock in trade. Law tells us don't pay tax, compute income in the year of conversion, but pay tax in the year of actual sale of the business asset. Now the problem, the audit challenge that one faces is this conversion is not a transaction that you will find in the bank account statement. This conversion is mere intent of the SSC. I am holding 10 lands as my investment property. Tomorrow, all of a sudden, I decide, okay, out of this 10 lands, 2 lands, I will now convert it into a real estate business. I'll build up apartments, I'll enter into JDA, and I'll commercially exploit this. But this is just an intent. This is just a conversion which is happening in my mind. You will not find it in your audit documents. You will not find it in the books of accounts of the SSC, right? So here we necessarily have to rely on a management representation letter that there has been no conversion of capital asset into stock and trade during the year, and this management representation has to be accompanied with a disclaimer in our tax audit report. The sample disclaimer is as per our examination of books of accounts. For some cases, it is possible that the SSC is also partial entry in the books of accounts. So he's moved out the asset from investments, and he's now put it into current assets, or now he's reclassified it as inventory. If you're able to identify if the accountant or the SSC has passed such an entry, then I think life is simple. But if not, we are relying on management representation, and which is why the disclaimer. As per our examination of books of accounts and as per the information explanations provided to us by the SSC, there were no instances of capital assets converted into stock and trade by the SSC. And I think it's a safe practice to put this in every tax audit report, unless there is an actual reporting in clause 15 that is happening. So we have a question from CA Gunashekar. Listed securities can be converted into stock and trade. If so, how it is to be taxed as business income? Yes, sir. So in fact, there are CBDT circulars to this effect to say I can hold 2 portfolios. I can have a bunch of investments and listed securities, which I'm saying are my investment assets. So I will offer gain on sale of these assets as capital gain. And at the same time, in the same balance sheet, the same SSC can have a bunch of securities which he claims as his trading assets. It can be held as inventory. So it is end of the day, from a documentation point of view, it is all going to boil down to where are you capturing this in your balance sheet. In your balance sheet, are you grouping them under investments? Then the gain is going to be taxed under capital gains. If you're grouping them under inventories, then it is going to be business income. So there we have to be a little cautious. We have smart SSCs who have no categorization. They just say shares, cost of shares. It is for the assessing officer or the auditor to break his mind to say this cost of share, is it an investment asset or is it a trading asset? Right. Amounts not credited to profit and loss account. It's been a major headache for the intimations that we've been receiving for assessment year 21-22 returns. Now the reporting requirement, reporting expectation here is all those items of incomes which for any reason have not been credited to the profit and loss account of the SSC have to be reported over here, right? In companies, it could so be that some grants, some items of incomes for some reason have been carried to reserves. Most commonly, most popularly, we'll see this clause being applied in proprietary concerns. So there are a bunch of incomes which you will credit in the P&L account, and there are certain non-business incomes appearing in business assets, appearing in business books. So the income has come into the business bank account, it has come into the current account, but rightly it is not grouped under, it is not credited to the P&L account, but SSCs tend to carry it to the capital account. So it is credited to the capital account. So let's take an example of rental income for our discussion. So if there is a rental income which is not credited to the P&L account but credited to the capital account, should I be disclosing under clause 16? Let's answer that question first. Clause 16, subclause A. Now this deals with items which are falling within the scope of section 28. So section 28 deals with business income. So only if there is a business income not credited to P&L account, I will be invoking clause A, otherwise no. So my rental income is not business income, it will not come under clause A. Duty drawback, performer credits, no. Escalation claims, no. Any other item of income should I be reporting out over here? The answer is yes. It's an item of income earned by the SSC during the year, appearing in the business books, but not credited to P&L account, credited to capital account. So I have to report it over here. But unfortunately, this is not well understood by CPC. Now, the way CPC reads this is, at the time of processing the return is, any item that you report over here, they expect it to be an item of income which should get captured in your PGBP income. I would have reported under clause 16D, but at the same time in the ITR, I would have reported it under income from house property schedule. They don't understand this. You will get an intimation, you will get first a 143(1)A notice, a proposal notice, no matter what response you file, no matter how much you shout and clarify in your response in the limited space available in the text box, it will all be ignored and you will get a demand. You will get an intimation raising a demand. Now, what is the solution to this? Solution number one, don't report. Not a nice, not an elegant solution because that goes against my reporting obligation. Solution number two, let them raise a demand, go and fight it out in appeal, which may again not be a practical solution, particularly in cases where I have small bank SB interest 15,000, the demand raise is 3,000, 5,000, not worth going into litigation. Solution number three, I'm slightly going out of my today's topic, but I thought it's very relevant. Solution number three and the most effective solution would be in Schedule BP, these items of income which you're reporting under clause D, added back to income from business under row number 23, which deals with any other item of income covered under section 28 to section 44. Added back under row number 23 and then reduce it under row number 32, any other item of deduction. This plus and minus exercise will save you from CPC demand. But again, a word of caution over here. If the amounts that you're reporting in row number 32, any other item of deduction is a material amount, if it's a substantially large amount, you may have solved your problem with CPC, but then you may get a scrutiny notice from assessing officer. Other deduction claim let's pick this up for scrutiny. So subject to that rider, these are the options available to you before you. So we have a question from a participant. Where does interest on FD go for companies? Other sources or business income? In the context of clause 16, I would say that it would go under, it would not have to be reported under clause 16 because it is anyways credited to the P&L account of the SSC. Under clause 16, I don't see that as a reporting requirement. Now, answering your question in the context of income from computation, in the income computation statement, I would put it under income from other sources if it's a surplus fund that I am holding on and I've parked it in some investments. If I parked surplus funds in FDs and I'm earning interest out of it, to me it is income from other sources. But if it's a temporary surplus, I have a running OD or I have a running loan account from bank, but I have a 2-month surplus lying with me, which I've temporarily parked in my FD, and that FD is funded out of my term loan, then that interest income is against my business expenditure, and I would retain it in my PGPP computation. I would not move it to my income from other sources computation. Okay, there's another issue on clause 16. Incomes netted off against expenses. A good example would be discounts. Distributors often get discounts from manufacturers to be passed on to retailers. So there is a discount received and there is a discount allowed, which in the penal account is netted off. Right? I don't reflect normally in my penal account discount received and discount allowed separately. Now, in such scenarios, the ICI in the guidance note tells us that this has to be reported in clause 16 because this is an item of income which is not credited. It is reduced from my expenditure but not credited to my P&L account. So on a strict interpretation, ICI in the guidance note tells us that this has to be reported. But then the moment you report this, CPC is going to chase you back with a demand notice. Life is going to be tough even at appeal stage, because in the faceless appeal, explaining this also could become a challenging situation. Therefore, I have a suggested note for such scenarios. The assessee has not credited the following expenses to the profit and loss account, but has netted off the same against relevant expenses incurred. As this is only a matter of presentation and has no bearing on the income computation of the assessee, the same is not reported under clause 16 of form 3CD. Right? So I have saved myself from CPC. At the same time, I have tried to comply with the mandate of ICI in its guidance note as well. Clause 17 deals with 43C and 50C, which we know are anti-evasion provisions. So if there is a sale of immovable property which is happening at a price less than the guidance value, then there is a trigger under 43CA and section 50C, which will have a reporting obligation under clause 17. Without getting into too much technicalities of legalities of these 43C and 50C provisions, if there's any specific legal position that you've taken with regards to this transaction, please make adequate disclosures in your form 3CD. Clause 18 deals with depreciation. I think this is one standard disclosure that everybody makes in his form 3CD. The opening written down value and classification of fixed assets is adopted on the basis of income tax records of the immediately preceding previous year. So when I'm certifying depreciation computation, my depreciation computation is to a very large extent dependent on the numbers of my opening block, opening WDV. Now that is something which I'm not verifying on a year-on-year basis. I'm blindly and simply taking what is being reported in the previous year's ITR. So the closing WDV of the previous year's ITR automatically becomes opening WDV of my current year ITR. I'm sure none of us put any audit efforts into verifying the closing balances of the previous year. So this is a necessary disclaimer that should form part of all SSCs wherever there is a depreciation claim. And then as informed to us, this is the second disclaimer that we give, as informed to us, the additions made to fixed assets are put to use from the date of purchase. So this is something that we have to rely on the management. We have to rely on a management certificate. If there's a big machinery for which an installation certificate is available, I know precisely from the installation certificate what is the date put to use of that fixed asset and from where the depreciation counter and meter should start. But then for simple assets like, let's say a laptop bought on 2nd of October. Now, was it put to use on 2nd of October? Because 2nd of October is a holiday. Probably he just went to XP Road, bought it and just, let it lay in his office and unpacked it only on 4th of October. We don't know. So we necessarily have to rely on management representation. If the management is representing that it was put to use on 2nd of October, I think this is something that we have to accept. There cannot be any other audit evidence. There is no other audit trail to verify this. And based on that management certification, we have to go ahead with our depreciation computation, and this disclaimer in our tax audit report should come to our safeguard. Clause 20B, dealing with delay in remittances of ESI and PF contributions. Now, this was one standard disclaimer, disclosure that we used to put in all our previous audit reports. But then with effect from assessment year 21-22, this disclosure is no longer going to come to the rescue of the SSC. Basically, it has to deal with the controversy of whether the due date for remittance is the respective statutes or the due date under 139(1). The stand earlier taken was employees' contribution. If it is remitted within 30th September or 31st October, whatever the due date for income tax return, and not within the due date of the respective statute. So April month's employee contribution should have been remitted before 15th May. Otherwise, it calls for a disallowance under 3615A. But then there were judicially beneficial judgments to say, bunch of beneficial judicial court judgments to say, even if it is not remitted before 15th of May, but remitted before the due date on the 139(1), no disallowance is called for. All of those have been negated by way of the amendment which was carried out to 3615A and 43B. So this is a disclosure. If you're carrying it forward from your previous year's audit report, please delete it, which is why I have highlighted over here. Clause 21A has a series of problems, had a series of disclosures to make. Personal expenditure, where the SSC is a company, this is a standard disclosure, standard reporting that we make in all Form 3CAs for all company tax audit reports, that the SSC is a company. Now, a company is not a person, it is not a living person, it is an artificial, it is a legal entity. It cannot have any personal expenditure because it's not a person, it cannot spend money on itself. So we are always of the view, legal view, that a company cannot have personal expenses. You cannot have any disallowance in the case of a company under 37(1) on count of personal expense. There could be illegal expense, there could be penalties, and all of that is fine. There could be capital expenditure, but there cannot be a disallowance on count of personal expenditure, and which is why this disclosure is relevant for a company's tax audit report. The question of personal expenses in case of a company normally does not arise. The expenses incurred under contractual obligation, service rules, normal business practice have not been considered as personal expenses. 37 disallowances. Again, a standard disclaimer is given to say, since it is practically very difficult for us to verify each and every transaction of the business of the SSC, we have relied upon the information provided by the SSC and necessary test checks and audit procedures to collect the information under this clause. I cannot be doing a transaction level audit. So I, in my course of audit, may have missed some of those transactions which are otherwise disallowable under section 37, but then this is how audit practically works. 48.3 disallowance. Again, there is no way I can verify whether the checks issued by my SSC were crossed with the words account pay. There have been a lot of instances where SSCs issue checks without crossing or just crossing it with 2 lines. Now, we are all aware that cross check is different from an account pay check. The requirement under 48.3 is it should be an account pay check. But once the check is issued, unless the SSC maintains a Xerox copy of each and every check that he issued, there is no way I can be verifying it. Neither the bank statements help me in identifying whether the check is an account pay check or a cross check. So I take a management representation and make a disclaimer in my tax audit report. In the absence of evidence in possession of the SSC, it is not verifiable whether payments by check drafts are by account pay checks or account pay drafts. Okay, this is a standard disclosure you will find in all our tax audit reports. Now, the standard disclosure should also be accompanied by a management representation. Now, this is a format, a possible format which can be made use of to take representation from the management to say all the checks, all payments in excess of 10,000 have been made only through account pay checks. Right? So this, along with the disclaimer in the Form 3CD, should ensure your 48.3 compliance. Should cover your 48.3 compliance. Clause 22 has a reporting requirement with regards to amounts inadmissible under Section 23 of MSMED Act. Now, Section 23 of MSMED Act is unique in the sense that this is one of the very rare instances wherein a third-party legislation, outside legislation, is overriding the Income Tax Act for the purpose of income computation. Right. So, MSMED Act Section 15 says, within the agreed period or within 45 days, the MSME vendor has to be paid his dues. Section 16 goes on to say, if it is not paid within 45 days, then there will be an interest that will have to be paid to the MSME, which is 3 times the RBI rate. So Section 23 goes on to say that interest which is paid under Section 63 will be disallowed for the purpose of income computation. So this disallowance, you will nowhere find it under the Income Tax Act. This is a disallowance flowing in from MSMED Act. Now the challenge here is, ICC would not have identified MSMEs at all. So the question of identifying delays, computing interest, and then disallowing it is a very far-fetched question. It's a very far-off question. First step is identification. Now, identification itself has not happened in the books of accounts of the SSC. Then a standard disclaimer that can be given is, in the absence of proper details in possession of the SSC, we are unable to verify and furnish the amount of interest inadmissible, if any, under Section 23 of the MSMED Act. This is again a standard disclosure which can form part of all our tax audit reports. Payment to relatives, again, there is an audit challenge here. challenge is identifying relatives. Now, my sources for identifying relatives for a company at least could be my DIR 8 or MPP 1. I could look into, if there's a statutory audit which is already conducted, I could look into the related party disclosures, AS18 disclosures made in the financial statements. I think that's it. Pretty much that's it. Beyond this, I have to be wholly reliant on the company, on the SSE for disclosing his relatives. There is no way I can check each and every vendor and trace it to the SSE to say whether he's a relative or not. So I have practical constraints which I seek to address by way of a management representation. And that management representation has to go along with this disclaimer to say payments made to persons covered under 48(2)(b) is correct as per the list of relatives furnished by the SSE. So the relatives are identified by the SSE. There is no way I can identify his relatives. I cannot be asking for his family tree. I cannot go into his birth records or family records. I have relied on management representation to identify relatives, and wherever he is identified a relative, those payments made to those relatives is what I am reporting under clause 23. Clause 27, I have an interesting observation over here, possibly not to deal with today's topic in strict sense, but then somewhere it is certainly connected with our today's discussion. Now, under clause 27, do we go on to disclose input tax credits under GST? Should it be reported or not? Should the opening balance of ITC availed during the year, ITC utilized during the year, and closing balance of ITC be reported under clause 27 or not? Is the question over here. I would love to see answers in the chat box. In my personal view, you should not. In my personal view, you should not. Because you will see this input tax credit, amount of central value added tax credit / input tax credit appearing in the form 3CD, which gets generated after you've uploaded the JSON file. So after uploading the JSON file, the form 3CD that you download will have this central value added tax credit / ITC. But if you pull out the legal books, if you pull out the legal form 3CD and read clause 27A, it still, even till date, reads only amount of central value added tax. This / ITC is not there in law. It is something which the Directorate Systems has inserted in the form 3CD, which is getting generated on the online portal. And Directorate Systems has no power to modify the income tax form. He has no power to modify a legal form. So that modification brought in by him, that extra requirement of he asking us to report GST credit is not binding on us. It is a very possible and legally correct view to take, that what is required to be reported is only SENVAT credit and ITC credit is not required to be reported. This view, in fact, finds support in our Institute's latest guidance note. 2022 edition will also talk of only SENVAT credits. The Institute nowhere requires you to report GST input credit over here. Out of extra love and affection towards the department, if you are willingly reporting it, department is very much happy with you. They are not going to dispute this. But not reporting it also cannot be disputed by the department, because simply because the law does not require us to report so. Clause 29A. Clause 29A deals with forfeiture of advances received towards sale of immovable property. Now, this has to do with income which is taxed under 56(2)(9). Now, until 2014, any advance received towards, any advance forfeited would get taxed in the year of sale by way of reduction from the cost of the asset. But with effect from Finance Act 2014 amendment, the law stands modified. We will not wait for the asset to actually get sold for income to be taxed. In the year of forfeiture, it has to be taxed as income from other sources under 56 subsection 2 clause 9. Now, the problem here is identifying forfeiture is a tricky audit situation. Now, out of commercial prudence, you will find that all sale transactions where there is an advance followed by a sale to be concluded at a later date, you will have a forfeiture clause. Now, let's say in the course of your audit, in the case of your SSE, there is an open transaction towards sale of immovable property. Pretty sure that sale agreement will have a forfeiture clause. Now, there is a forfeiture clause, but do the parties actually intend to invoke that forfeiture clause? It could also so be that your assessee has sent out a forfeiture notice to the buyer, not with an intention of forfeiting it, but with an intention of forcing him to conclude the contract. Actual forfeiture, whether it has happened or not, can be a tricky situation. And ICI in the guidance note tells us that please apply your professional judgment and make adequate disclosures. So a sample disclosure that I have given out on the screen is, of course, you'll have to tweak it to suit the requirements of your facts. The assessee has entered into a transaction for sale of so-and-so property, for which the assessee has also received an advance of rupees so-and-so. The transaction was supposed to be completed before a certain date, but it is still open. The contract provides for forfeiture of the advance at the option of the assessee. However, the assessee does not intend to forfeit the advance and is rather keen on concluding the transaction. The advance received continues to be reflected as a liability in the books of accounts of the assessee. I think this is key. If in the books of accounts he has written it off, then there is no doubt that it is the amount has been forfeited, and even this clause is not going to save you. As long as it is disclosed as liability in the books and there is an intention which is demonstrated by the assessee in terms of not forfeiting the advance, but in terms of making attempts to conclude the transaction, this disclosure requirement should safeguard your audit, should cover your audit risks. So the advance received continues to be reflected as a liability in the books of the assessee. In the absence of actual forfeiture by the assessee, no incomes are reported under clause 29A of Form 3CD. Clause 31 has reporting requirements with regards to 269 SS, 269 ST, and 269 T. Again, a common set of disclosures or disclaimers that we give. Before that, I see a bunch of queries over here. Where 269T repayment is adjusted by raising an invoice. Okay, so 269 repayment by way of journal entries, that's something which is covered in our next slide, sir. I hope the slide answers your question. If not, we can always come back to you. So these are a bunch of two standard disclosures that form part of our office tax audit reports. Number one, in the absence of evidence in possession of the assessee, it is not verifiable as to whether the acceptance of loans or deposits and repayment of loan or deposits by way of account paid checks or account paid draft. The same issue that we face for 48.3. The payment has been made through check, but whether the check was an open check, cross check, or an account paid check is something I cannot verify, and I am reliant on my assessee's management representation, and I am to that extent giving a disclaimer in my tax audit report. Second pertinent question which comes to the mind of a lot of us professionals is, should payments or receipts by way of journal entries be covered under this reporting obligation? Now, if you have to read the latest guidance note of Institute, the 2022 edition, Institute says yes, even journal entries are covered. They have taken a very strict and literal interpretation of provisions of 269 SS and T to say even that constitutes a violation. But then I feel that's a very harsh view taken by the Institute. There are a bunch of judicial pronouncements which go on in the favor of assessees, wherein the language of 269 SS and T has been, toned down to say journal entries do not violate provisions of 269 SS and T. I know there are a small number of judgments which have gone in favor of department also, but majoritively courts across the country have favored the assessee on this aspect, and I think it's safe and okay to take the view taken by majority of the courts. A sample disclosure could read something like this. It has been held in following cases that the transactions by way of book adjustments, that is journal entries, are not monies taken or accepted and are therefore outside the purview of 269 SS and 269 T. So there is neither any acceptance or neither there is any money which is actually taken, and therefore it is outside the net of 269 SS and 269 T is the majority view of most of the tribunals and courts. Most prominently, Pune Terminal, Sunflower Bridge, Delhi High Court, a landmark judgment, Noida Toll Bridge, again Delhi High Court, Worldwide Township Projects Limited, then there is Ahmedabad Terminal in the case of Gujarat Ambuja Proteins, and there is a host of other decisions also following these. Majoritively, as I said, courts have taken a lenient interpretation in the favor of the assessee to say no further, there are no defaults, there are no violations, and no penal provisions are retracted. So in the light of these case laws, one can conclude that for the purpose of reporting under clause 31, amounts of loans accepted and loans prepaid do not include any transactions by way of journal entries. Mr. Gunshekaran, I hope this has addressed your query. If not, we can again connect towards the end of the session. Again, a sample representation format which can be used to take the management certificate. Clause 33, here we have to be very careful. Now, before I come to this, I'll have a question for all of us to answer. Now, proprietary concern, SSE runs a trading entity. He maintains two set of books, personal books and business books. Personal books are outside the business books. So there is a savings banks account, there is some investment happening in personal capacity, which is not coming into his business books. Now, from his personal bank account, if the SSE has made, let's say, a ATC investment, a PPF deposit, or he bought a life insurance policy, entitling him for a ATC deduction of, let's say, 1,50,000. Should I be reporting it in clause 33 or not? Should I consider that or not? I'll repeat. There is a ATC investment made by the SSE outside his business books. It is being made in his personal books. Now, should that be considered for the purpose of reporting under clause 33? For my income computation statement, I will certainly take that ATC benefit. That 1,50,000 deduction, I will definitely take, no doubts on that. But when it comes to reporting as a tax auditor under clause 33, should I be reporting that or not? The problem of me reporting that ATC deduction which is lying in personal books is it is conflicting, it is contradicting my consistent stand throughout that I am verifying only business books. So if I am verifying only business books, how come a deduction which is made or investment which is made out of personal books is being reported under clause 33? So I'm contradicting my own stand, right? So not reporting it is again a problem, because I not reporting a ATC deduction under clause 33, but the SSE claiming it under income computation statement might result in a flag which might ultimately result in a scrutiny, is the general perception and fear of SSEs. So how do we address both? How do we balance both? We balance both with the help of this additional disclosure in the tax audit report, which is no deductions are allowable under Chapter 6A in respect of business income of the SSE. In the business books, there are no deductions. Deductions under ATC, ATTTA, ATD, you can continue with the list. Reported under this clause is as per the information declared by the SSE. So I am not verified as business books. I'm not verified as personal books. But there are certain investments that is made out of personal books and which is brought to my notice. I have verified the payment made. I have verified the LIC policy. I have done the 10% math. I have satisfied myself, and then I am allowing it under clause 33. Should balance out both the positions of the SSE as well as the tax auditor. Clause 34 with regards to TDS, again, it's difficult to do it at a transaction level, and necessary disclaimer should be made in the tax audit report to say we have verified the compliance with the provisions of chapter 20 or chapter 18B, 17B in respect of the tax deduction at source and tax collected at source in accordance with the accounting standards generally accepted in India and recommendations of ICI, which includes test checks and concept of materiality. So I've not done a transaction level audit. I have adopting the standards of auditing, done a test check, considered materiality, and accordingly reported any compliance or non-compliance under clause 34A. There could be instances where in simple trading entities, there were no payments at all during the year which required TDS. There again, a simple disclosure can be made to say there were no payments made by the SSE during the previous year under which during the previous year under audit which require tax deduction at source. Hence, answer to clause 34A has been filled as no. Because clause 34A, the question is whether the SSE is required to deduct tax at source. He is required to deduct tax at source. His turnover in the preceding year has crossed 1 crore, but there were no transactions requiring tax deduction at source. So that is how you would disclose it in on 3 series. 34B. Now there is a reporting requirement which mandates us to verify whether the TDS returns have been accurately filed or not. So basically, we have to do an audit of the TDS statements as well. It quite often happens that books of accounts give me 10 items of deductions. There are 10 deductions, but in the TDS statement, only 8 deductions are reported. Now, there are two options available to you for the closure of your tax audit. Option 1, get the TDS statement revised. Those 2 missing transactions, please add it in the TDS statement and then upload the TDS statement and then give the SSE a clean sheet under 34B, or those 2 transactions which have not been reported in the TDS statement will have to be reported here under 34B. And rightly, wrongly, fortunately, unfortunately, this 34B in the utility gives you a text box which will not at all help you in reporting those deductions, those line items which are missed in the TDS statement. You will necessarily have to state in this text box here that it is as per annexure or it is separately reported in the observations column of Form 3CD, and that will again have to separately go, not as a reporting under 34B, but as a separate annexure. (34C) whether the assessee is liable to pay interest under 201(1)(a), 206(c). If yes, the details thereof. Interestingly, the question asked is whether the assessee is liable to pay interest, but the reporting is possible only if the assessee has actually paid interest. If the assessee is not paid interest, you cannot leave this column number 3 blank. It will not allow it to report at all. So all such instances where the assessee is liable to pay interest but is not paid interest will necessarily have to go into our observations column, that is para 5 of Form 3CB or para 3 of Form 3CA. Or maybe as a separate annexure, you scan it and upload it along with your financials that you upload at the time of filing the tax audit report online. Quantitative details, again, I think this is one standard disclaimer which goes into all trading entities where stock records are not maintained. Day-to-day quantitative details of stock have not been maintained by the SEC. The non-maintenance of records is stated to be on account of nature of business involving trading in numerous variety of items. In the absence of relevant records, it is not possible to verify and furnish the quantitative details. I think that's one standard line which goes into all trading and manufacturing entities where stock records are not maintained. Moving on, clause 41. Here the reporting requirement is furnish details of demands raised or refund issued during the previous year under any tax law other than Income Tax Law and Wealth Tax Act, along with details of relevant proceedings. Now here we have to be a little cautious because SSEs today are very smart. So if there is a GST proceeding, let's say there was a GST inspection at the premises of the SSE. Now from his VAT regime, the SSE has got sufficient knowledge. He's now well aware that any penalty that he pays on the unaccounted sale will not be allowed as deduction. So he very smartly, what he does is he pays that penalty and that additional tax from his personal books, not bringing it into his business books at all. And because I am restricting myself only to business books, I am not even aware of that proceeding which has happened. Smartly, he's hidden that file from the accounting records also. So I will necessarily have to take a management representation for the purpose of this clause, and that management representation has to go with a disclaimer that details furnished under this clause is as per the details furnished and limited to the entries made in the books of accounts under audit. So I've examined the business books. In business books, I'm not finding any demand raised or refund issued. I've also taken a management representation letter to the effect that there has been no proceeding initiated in his case during the year of my audit. Beyond this, there's nothing much I can do. If there is something which is happening in his personal books, which is happening beyond outside his business books, which he's not disclosing it to me, I am helpless, is what I'm effectively stating in this disclosure. Coming to clause 44. Clause 44 disclosures, I think, have had the most widespread circulation in all WhatsApp groups, in all study groups, in all mails, in all presentations, in all disclosure. I think this year's sessions on Form 3CD would have been incomplete without a discussion on clause 44. There's a lot of material available on how to report, how not to report, what to report and what not to report. Without getting into too much details of that, I'm just going to leave you with certain standard disclaimers or disclosures that you can make use of for the purpose of your audit. For clause 44, as far as I'm concerned, I see only two possible scenarios. Scenario one, somehow you're able to compute that impossible data and you're disclosing it, you're reporting it in clause 44. That is the breakdown of your expenses, registered entity, unregistered entity, composite dealer, exempt, taxable. If that Herculean task is in any way being achieved by you, even if it is not coming to level of 100% accuracy, if it is coming within the materiality thresholds that you have set for your audit, then this could be a disclosure, this could be a observation that you might make use of for the purpose of reporting in your Form 3CB or 3CA. We have verified the breakup of expenses registered or not registered under GST as provided by the SEC in accordance with the auditing standards generally accepted in India and the recommendation of ICI, which includes test checks and concept of materiality. So using test checks as tools and keeping in mind the concept of materiality, this is the number that I'm reporting in clause 44. This is option 1. Option 2, the most favored option, do not provide any information and give a total disclaimer in your Form 3CD. And the total disclaimer would read something like this. Assessee has submitted that books of accounts have not been maintained in a manner to provide GST breakup of expenses, as there was no such requirement in the earlier years. It would practically not be feasible to rewrite the entire books considering the new reporting requirement. Further, expenses like salaries, depreciation, bad debts, discounts, etc. are not supplies under GST and therefore cannot be bifurcated as per the requirements of clause 44. In light of above and voluminous transactions, we are unable to provide details as asked for under clause 44 of Form 3CD. Right. Option 1, option 2 is a choice to be made by you. Do we report or do we not report is a lengthy discussion that you'll have to have with your clients. You'll have to have within your office. Is your office competent enough to compile this data, or let's say even if the data is compiled by the audit by the SSE, do you have the time and resources to verify that compilation? And most importantly, what implications would this reporting carry in your GST audits is also something that you have to keep mind, keep note of before coming to a conclusion whether to report or not report. Quite possible that with the kind of information exchange that is happening between the GST and Income Tax Department, this data under clause 44 would be forwarded to the GST authorities, and at the time of GST audit, if they come back and ask you a reconciliation of these numbers with GST returns, GSTR 2A books of accounts, then life would be really very difficult. So make a conscious call on whether you want to report or whether you don't want to report, and make use of appropriate disclosure templates that are provided to you. I think with this we've completed our, at least my set of disclosures that I had in mind, which could be of common use to members in practice. If there are any additional requirements, additional inputs from the members, participants present here, we are free. We are now open for a open discussion now. You can type in the chat box. Pramod sir, is there a way we can unmute them? Can they also speak out? No, that's not technically possible. So you can type in your queries, type in your value additions. We will share it with all the participants. Is there anything in the Q&A box? Oh, there's something which has come in the Q&A box as well. I hope you're sharing your PPT immediately after the seminar. Yes, it will be mailed immediately right after the seminar, and the branch, I'm sure, will put it up on its website. It can be made use of. Can we get a copy of the slide or presentation? Yes, certainly yes. That's one repeated question that I see. Anything in the chat box? Nothing that I see in the chat box.
Deepak, a suggestion, would you like to take some of ICDS in detail or ICDS points, because we have some time left?
Yeah, I see some queries in the chat box also. We'll just complete that first. Can we get copy of the slides? Yes. Shrikar is. If it's for the first time company and financials is drawn for, let's say, October to March, do we use 3CA, 3CD or 3CB, 3CD? If you're drawing statements from October to March, then that is also syncing with the previous year concept that we have under Income Tax Act. It is the same set of financial statements that you will use for your tax audit report also. So there you will use Form 3CA, 3CD and not Form 3CB, 3CD. Only if your financial statements are drawn for a period more than 12 months. Under company law, you're permitted to draw up to 15 months. So if there is a financial statement under company law for more than 12 months, only in that scenario, a company would be using 3CB, 3CD and not a 3CA, 3CD. Now there's one more. If a huge expenditure on advertisement and sales promotion is incurred during March month, whether it can be taken as expenditure for the same year or it needs to be carried to next year. Strictly speaking, not a question for today's session, but I'll make an attempt to answer it. we no longer have this concept of deferred revenue expenses under accounting standards. AS 26 no longer permits you to defer your expenditure. So all marketing advertisement expenses incurred in the month of March have to be booked in the month of March, unless the let's say the work is carried out on, let's say, April. So for example, let's say I have made a payment to a advertisement company for setting up a hoarding, and that hoarding is going to be displayed in the month of March, or it is spilling from 15th March to 15th April. I paid a 1 month hoarding rent. Then I'll have a prepaid component. Otherwise, everything is current year expenditure. There's no concept of deferred revenue expenditure any longer. Okay, we'll pause for a minute more for more possible queries. I would like to conclude with a small rhyme. Disclose and disclaim. So all your disclosures, all your disclaimers, qualifications, wherever applicable, please report them at appropriate areas of your tax audit report. Else, disclose and disclaim, else our practice will close and we'll be slain. I know it's a very bad try to make, but then I hope the message has been effectively communicated. So see, we are living in an era where chartered accountants are put to a lot of scrutiny. There are a lot of eyes scanning the work that we are doing. There is ICI regulatory authorities. There's a tax audit quality review board sitting on us. There is disciplinary committee taking actions against professional misconduct. There is a tax audit quality review board now, which is going to review our tax audit reports. There is a penalty under 271J. There's a sword of two penalty provision hanging on our head. So all of these can be safeguarded. We can safeguard it from all of these only by way of making adequate disclosures and adequate disclaimers and adequate observations in our tax audit report. I think that's the only way that we can safeguard ourselves. Otherwise, we carry a lot of audit risks, which without adequate disclaimers and disclosures are going to put us in trouble. Right. So with this, unless there are any more questions, is there? I don't see any more questions. Not in the Q&A box. So, with the permission of Chairman, sir.
I think all the questions done, sir. Excellent session, sir.
Thank you.
It has benefited a lot of members. It has given clarity. It's really helpful during this audit season. Even in your busy schedule, you have made it this day, sir. I thank on behalf of Bangalore branch of ICA for your time and efforts in sharing your valuable knowledge, sir. Thank you.
I thank you, sir. Thanks the branch. I thank the office bearers of the branch for having given me this wonderful opportunity. And most of all, I thank all the participants who have given a very patient hearing and they've spent their valuable time online with us. Thank you also. Thank you.
I thank all the participants for active participation also. I thank on behalf of Bangalore branch of ICA. Thank you. Pramod, you can give formal vote of thanks. Secretary.
Sir, you're on mute.
You are on mute.
Let's give a formal vote of thanks. I thank each one of you for taking an active interest and attending this session. Hope this session improved the knowledge kitty of our members, and we know what to disclose and what to disclaim in the tax audits which is going forward. I thank each one of you on behalf of Bangalore branch of SISC for gracing this event and coming to the seminar in large numbers. Thank you, everyone.